He's accredited as he's accredited as certified valuation analyst by National Association of Certified Valuators and Analysts, USA. Rajesh is a founder and chairman of Almac Capital and Advisors Private Limited, engaged in investment banking and corporate financial advisory. Prior to 2012, he spent 25 years with prominent corporates in leadership roles in finance. Mr. Rajesh has extensively worked as management consultant and strategic advisor. He has handled several M&A deals spanning across diverse industries and geographies. He has in-depth understanding of valuation and strategic growth of business. He has served as an independent director on board of listed and unlisted companies. He has been a nominated member of the committee formed by IBBA, ICICI RVO, and ICAI. He is a frequent speaker on CSR and valuation platforms of ICAI and ICICI respectively. Mr. Rajesh is a partner of Dasani and Associates Chartered Accountant. He is a Rotarian and a charter president of Rotary Club of Delhi Manthan. Over to you, Mr. Rajesh. We welcome you.
Thank you so much, Mr. Ravi Chandran. Thanks for such a generous introduction. And a very warm welcome and good morning to all the participants. So let me start with a simple anecdote. When I received an invite from BVA to speak on one of the Saturday mornings, and I think the time chosen is really wonderful. 7:30 to 9:30. Nobody can say that, look, I'm busy, I got some meeting, or I'm going out for dinner, whatever. So that actually time works beautifully well. So when I got this invite and the choice of topic was left to me, so I thought, what should I do now? This is a bigger dilemma. And then I started thinking in my mind as to what has bothered me the most as a valuer. And I came to this point that this subjectivity element is bothering me the most. Every valuation I try to struggle as to how do I deal with subjectivity element. And in the context of few of IBBI's disciplinary committee orders, it became more prominent in my mind. So I thought instead of, let me choose this topic. And this also gives me an opportunity to deep dive into the subject. So I'll share my perspective on this and also to interact with the fellow registered valuers who could give their insight and experience as to how have they dealt with some of these nuances. So this is the context of the topic. And with this context, I would expect each one of you to be interactive and participative so that we can share our collective wisdom on this platform. Let me set the context. And some of these things, what I'm going to talk in next 10 minutes, they will set the context of what we should do and how we should handle things. Let's first talk about what is the best barometer of value. The best barometer of value, if you read any book, any valuation standard, is the market price. If an asset is being traded in a market, then that becomes the natural, and the first choice of value. Now, we are giving emphasis, or standards are giving emphasis to the market price. Where is it coming from? The stock prices, we all know how they move up and down. We have seen the era of COVID. We are seeing the current era. We've also seen a whole lot of sentiment-driven market situations. So the best barometer of value is this the most reliable barometer. And then what it throws up is the non-control value of the shares. So we are still left with another additional item of D-log to be handled. Then in the context of market price, there is also, there are SEBI circulars. So when you look at ICDR or SEBI fair exchange ratio circulars, they talk about averaging, volume weighted average price. And they try to tell us that, look, take 90 days volume weighted average price or 10 days, whichever is higher, and that becomes the basis. Keep this in mind that the best barometer of value, which is the market price, that also comes with a lot of nuances. It has to be looked at constructively. It has to be looked at in the context of many other factors which are influencing it. Even if you try to average it out for a period of 90 days or 10 days. That brings me to the next point as to what is the real life. How do we handle the real life situations? If I want to sell a company, you want to buy, or vice versa, what will we do? We may have advisors, we may have valuers. Each one of them may throw up their own valuation. We would actually be sitting on the negotiation table, discussing and arguing about as to how do we handle this particular transaction. So I'm trying to take you slightly away from the valuation in the context of Companies Act or SEBI or income tax or IBC. So I'm shifting the focus on the core of the valuation, where the deals are struck, where the merchant bankers and investment bankers they operate. So then what happens is, in such a real life scenario, you would notice that valuation principles, valuation standard, it becomes a mere guidance. The rest is the negotiation and the ability to negotiate who needs whom and whose desire is much more to conclude the transaction. Let's talk about the third element, which is the IBC. Now, many of you would have handled IBC valuations. They expect you to decide liquidation value and fair value. Now, this valuation has been done by IBBI recognized, approved, authorized, registered valuer, and not one by two. If you check the statistics, you will notice that none of the transactions there happened on this fair value or liquidation value. Means there are other additional external factors which are influencing the valuation. A prospective buyer of IBC asset, first of all, he doesn't have access to the liquidation value or fair value. Even if he had that access, he may not be striking the transaction at that value. So keep this specific point also in mind, that the valuation done by a registered valuer is not the sacrosanct valuation which can be used for the purpose of consummating a transaction. In the context of IBC, we have also seen, Swiss challenge method, where counter bids are obtained. Original bidder is asked to match the counter bids, and if he does, he is awarded the contract. So this particular situation, it talks about a shifting or moving valuation parameters. Something has to change. Something has to meet with my desire to either buy or desire to sell. And then valuer has to look at it in that context. Many times, the buyer or the seller, they would try to pitch a very aggressive valuation. So what is the acid test? Acid test of any valuation is the actual transaction which has been consummated. That is the real value. That is what drives a valuation. That is where the parties are willing to shake hand. And that is the value which actually corroborates with the valuation standards. So if you look at the market value definition, it would talk about willing buyer, willing seller, arm's length, knowledgeable. All of these words have been used. So when does that happen? It actually happens when there is a real transaction on which term sheet has been signed and people are willing to either invest or divest. Then we come to the next aspect. So since I talked about the real transaction, now how the real transaction would take place. I have been in this situation many times where you are sitting on the negotiating table, you have done your valuation, buyer or seller on the opposite side, they also have their advisors, they have also done their valuations. Now is the question of sitting on the negotiating table And leave apart the entrepreneurial acumen. Many times valuers are overruled by entrepreneurs. They may not want what we are and the way we are looking at life. So let me confine myself for the time being to the two valuers sitting across the table, representing two different sides. Friends, believe me, each and every single parameter gets questioned, which you and me as a valuer need to defend. They will start right from the top, the revenues, where and how is it coming. They'll talk about margins. They'll talk about growth. There'll be deep-rooted discussion. And then rest of the stuff which we as valuers, handle, uh, discounting rates, beta, alpha, company risk premium, all of that comes into question. So this then brings another important point that valuation is not a precise number. It is always a range. You're dealing with a range. You also have a walking in position and walking out position. And in the context of negotiation, there are two different type of things we are dealing with. One is something which is given by the management, and the second is what is the core of the valuation. Now, if I talk about what is given by the management, of course, they have given the projected financial information that is also susceptible and open to subjectivity. If you talk about the valuation, valuers part, of course, we all know the elements of subjectivity over there. That brings me to the next topic or next subtopic, I would say, the regulatory valuations. Now, what happens in case of regulatory valuation? If a client comes to me asking for a valuation under section 62(1)(c) or asking for valuation under FEMA for issuance of shares, the board meeting date is already fixed. Now, what he is expecting from me, he has already struck a deal. He already has an investor. He already has a value with him. He is only expecting me to validate that value and give me a report which fulfills the requirement of the regulation. So now what should I do? And this specific question I have dealt with on multiple forums and while addressing the COP participants and registered valuers. They say, look, client has come to me and he's asking a particular valuation. What should I do? Should I take up the assignment? Should I give up the assignment? And my simple answer to that question is, what is the asset test? There is a willing investor at that value. Please check whether that willing investor is on arm's length or not. It should not be related party. And then objectively start looking at and doing the valuation. You may not come to the precise or exact number, but then the company that permits us that the whatever value is come up by the registered valuer, this is the minimum base value and the transaction can be struck at the higher value. So we have that flexibility. So that is the context of regulatory valuation, where the client comes to us when he has already struck the deal and he's only looking for validation. Now, if something is completely haywire and you are not able to handle that kind of a situation, and the numbers are way apart, that's a different situation. But believe me, in 99% cases, if there are two different investors and investee who are on arm's length basis, broadly, even if the transaction has been struck and you are asked to provide a regulatory valuation, you would reach broadly to the same number. Then we come to the next one. So we are dealing with the subjectivity part of valuation. Let me add one more point, one more word rather, I would say to this, which is the arbitrariness of valuation. And that is where the difference lies. Subjectivity, I'm happy to deal with, but arbitrariness, I'm not. And what is the difference between the two words? When I say subjectivity, I have applied my judgment. I have taken a rational view of something. I have some solid backing behind it. I have some solid links or web links or data points which support my decision. And then I have my whole lot of professional judgment behind it. So I have all of this, and at the same time, I communicate this through the valuation report. If I'm doing that, then I'm dealing with the subjectivity part of valuation. But the moment it becomes arbitrary valuation, then it says, okay, I mean, as far as I'm concerned, the value is 20 rupees per share, and there is no reference as to how this value has been arrived at, how the parameters have been looked at. That's the arbitrariness in valuation. We are not ready to deal with, or nobody is ready to accept the arbitrariness. In the subsequent discussion, in this session, we'll try to deal with as to how do we address these issues of subjectivity and arbitrariness. The way I look at it, a valuer has to be objectively subjective. You can't eliminate subjectivity, but you can bring objectivity in subjectivity. So long as you are objectively subjective, you are doing your duty, and you're serving your client efficiently, and you're helping the transaction, you're helping the overall assignment and engagement. We'll deal with this aspect of objectively subjective also in the subsequent discussion, because this is the crux and the key. You can't eliminate subjectivity. And by using the means which I just now talked about, you can bring objectivity into the subjectivity. That brings me to the next subtopic, which is the peer review. Now, peer review is something with which I have been associated with on behalf of ICSI RBO, and I have handled peer reviews for last almost maybe 4 or 5 years. What are we trying to do in the peer review? And fortunately, in the new IVS, which is applicable from 31st January 25, they have also recognized this concept of peer review. What IVS says is, are you doing valuation process review or you are doing value review? Very, very important. Valuation process review or value review. What IBBI expects as part of peer review is the valuation process review. The Excel sheets are not shared. The backup working papers are not shared. What you get is a copy of the valuation report in PDF with names, blackened out, client name blackened out, and you're expected to do a peer review. So essentially, you are looking at peer review, evaluation process review, where you comment whether the process has been right or not. Very, very important point. Not even IBBI or anyone is expecting or targeting towards the value arrived at by the valuer. What they are targeting at is whether the process is right or not. Has he applied the principles correctly or not? Has he followed the valuation standard or not? Has he disclosed each and everything which he ought to have been disclosed as part of the registered valuer rules, as part of standard, and as part of the commercial common sense? So this also reaffirms or reconfirms the approach of objectively subjective valuation. And with this, I move to the next subtopic, which is about IPO valuations. A merchant banker is doing a valuation under IPO. Now, imagine a situation. The IPO is heavily oversubscribed and the IPO is heavily undersubscribed. Why would it happen? Because of the value. Either the investor has heavily accepted the company and the valuation. And why would he accept the company? He would accept because of the valuation. He is sitting there to make money. Even the retail investor. A retail investor would go through a whole lot of analysis in economic times, newspapers, websites, and figure out and filter out the views of analysts and say that this price, this IPO is heavily priced, and I'm unlikely to make money into it. And he stays away from there. The situation results in undersubscription. So now here is a competent valuer sitting behind the IPO in the form of merchant banker, in the form of investment banker. In their wisdom, they have decided the value of that share and the investor has rejected it. What would you call it? Look at the other side. There is a IPO, the price is determined, and now it is oversubscribed by 100 times. Are you happy with that kind of a situation? And the IPO, when it gets listed, the price is maybe 50% or 100% more than the IPO price. Are you happy with that situation? If I'm the management, if I'm the promoter of the company, I'll be extremely unhappy. My simple point is, look, my company was worth X million or X billion dollars, and you price the share at X by 2. I lost that much of value. If it is offer for sale, I lost that value. If it was fresh issue, the company lost that value. And eventually I also lost the value. So where do we stand? Once again, it indicates the superiority of the actual transaction and the actual realities as far as valuation is concerned. This is a very, very classic example where the best of the brains are sitting, they are deciding the valuation of IPO, and the market either accepts or it rejects them. So friends, I just wanted to set a context as to where, in what kind of world we are living in and what are we dealing with. With this background, let me show some slides to you. And as I mentioned to you, I would expect you to share your experience, share your wisdom as to how have you dealt with those nuances. I will try to run the presentation in a flow of certain questions. And I've tried to find answers. And these are, mind you, theoretical answers. I not put any practical or any experiential based things from my side. And my expectation from you is that when we read the theory, we should also be able to imbibe some practical experiences and nuances around that. So let me share this presentation with you. Some of this part we may have already, discussed or handled. Client desires a particular valuation. Valuation done by any two valuers will not be the same. Very important. Now here, my view is if there are two valuers doing the valuation of the same company, and if the value exactly matches, I'll actually be a worried person. How can that happen? That gives me a sense that these valuers, they have collaborated with each other. How is it possible? The value of share of derived by valuer A is 10 rupees 49 paisa. Other one also comes up with 10.49. One can argue that, wow, wonderful. Two valuers, same value, fantastic, great job done. But then the trouble is there are always subjective elements involved in the valuation. And if there are subjective elements involved, How can two valuers arrive at the same value, exact same number? The next bullet deals with a valuer is required to make judgment on several aspects or parameters. We'll talk about this point. And share price is already negotiated. We already discussed this. And that brings me to the last point in the red, the rule-based versus principle-based. Take the case of income tax rule 11U. That's my favorite example. The act tells you what to add, what to subtract, what to deduct, what not to deduct, what to consider and how to consider. There's a great likelihood that the valuation derived by two valuers will be the same, because the law has given you that mandate that follow this procedure and you're following that. On some of the occasions, while discussing with IBBI officials, this point came up that can we make the valuation more rule-based? Now, if you try to do that, there are enough challenges around that. And I've already discussed about how the transaction gets struck. So if you try to convert the valuation into rule-based, it will never ever fit into the thought process of the investor and investee. You can't tell an investor or investee that in an automobile company, the discounting rate has to be 25%, period. That's it. That's a law. Now we come to the valuation approaches and valuer's judgment. You are all familiar with these three approaches. And by the way, I am adding the fourth approach to it, which is not written anywhere, objectively subjective approach. So keep in mind this fourth approach, which is not written anywhere during the course of this discussion, objectively subjective. Now, as far as market approach is concerned, we all know that we need to, the market is the best barometer. I have not mentioned that. You can pick up that data from the most authentic website of stock exchanges. Now, company comparable and transaction comparable. Finding similar companies is a very big challenge. The sample size. If I find only one company, can that company be reflective of my subject company? Maybe not. Maybe yes. So finding similar company and also finding a reasonable sample size and eliminating the outliers from that sample size is really the key. Many of the companies in your sample may or may not exactly fit into the nature, size, and type of the company which you are valuing. And then applying the right statistical tool. Averaging, is that the right tool? A famous example for averaging is if your head is in furnace and legs is in a freezer. On the whole, as an average, you will be fine. But that doesn't work. The person will die. So averaging is very, very dangerous. Maybe taking a median could give a better result. Talking about the second one, income approach. Most widely used approach is DCF methodology. So if you apply DCF methodology, the first thing which you need to decide is explicit forecast period. What should be what is the reasonable period of forecast? So we'll deal with this question. What should be the discount rate? We'll touch upon this point also. What is the company specific risk premium? Highly subjective. It's very difficult to pinpoint any specific number to company specific risk premium. No publication, no research material will give you any guidance about it. It's a pure professional judgment of valuer. Now, the key is how this professional judgment has been arrived at and how has this been communicated through the valuation report. And then terminal growth rate, what it should be. The theory tells us that terminal growth rate has to be lower than the GDP of the country because a company is not expected in perpetuity to breach the economic growth rate. That's what the theory tells us. Theory also tells us that it cannot be lower than inflation. So now we got some sense that TGR should fall somewhere between inflation and GDP. Right? Now, my question in my mind, the way I'm struggling, and maybe some of you may have a better answer. If I apply this theory, this terminal growth rate I'm talking about at the end of the forecast period, which could be 7-year, 10-year, 5-year, depending on the situation. What would be these parameters at the end of 5th year, 7th year? So even if I want to apply this range, there's a challenge. And that's where you will notice that it has been somewhere, if I see the reports of other valuers and what we have been doing, maybe fall somewhere between 1% to 3%, 4%, 5%. That brings the next one, asset approach. Now, under asset approach, you are trying to value an asset based on its reproduction value or replacement value. Maybe you can get a better sense of replacement value, but reproduction value, little tricky. And then finally, how much weight you should give to each of these approaches. That's also a question. So let's get some sense from what we have from the standards and what we have from the experience. While preparing for this presentation, I tried to look at how subjectivity or subjective word has been looked at by IVS. Interestingly, IVS has not defined this word subjective at all. There's no definition available. And this word subjective, when I did Control F, I found that it has been used at 4 places. I'll talk about those 4 places where it has been used in a while. But at the same time, IVS has defined the word professional judgment. And here is the definition in the glossary part, 10.22 of IVS. The use of accumulated knowledge and experience, as well as critical reasoning to make an informed decision. Friends, to my mind, it's a beautifully drafted definition. And this definition wasn't there prior to 31st January 25. So this is a new addition to IVS. Means IVS has recognized that professional judgment is something so important and so ingrained in the valuation process that it has to have a clear definition. So the emphasis is on accumulated knowledge and experience. What we have learned, what we've experienced, each one of us have valuation experiences, as well as critical reasoning. You should also reason out and then make the informed decision. And then, most importantly, communicate that reasoning through the valuation report. Let me share as to what are those 4 places where IVS has used the word subjective. There is IVS 103 10.12, which says that the price information from an inactive market may still be good evidence of value, but subjective adjustments may be needed. So this is one place where the word subjective has been used. And then there is 20.03 IVS 103 valuation approaches. This talks about information on market transaction is available, but the comparable assets have significant differences to the subject assets, potentially requiring subjective adjustments. So we talked about the context of comparable companies. So they would require subjective adjustments. So that's the second place where it has been used. And then it has also been used under IVS 500, which deals with the financial instruments, valuation of financial instruments 30.01. And it says that, I'll read out only the last one or two lines. It's a very long para. That depending on the nature of the financial instrument being valued, as well as the frequency and the complexity of the valuation, the valuer may implement a range of processes which are highly automated using systematic mappings and data feeds to others that are highly manual and subjective. So here the emphasis is on the negative side. Do not use highly manual and subjective processes. You should use range of processes which are highly automated. So in the context of financial instrument, the word subjective has been used, but it has been used to eliminate the subjectivity part. So keep that in mind. Now comes, I've prepared it in a manner of question and answer. So how much weight should be given to each approach? And this is what IVS tells us. The appropriate basis of value and premise of value determined by the terms and intended use of the valuation assignment. So you should consider specifically the valuation basis and premise. Now, if your premise is forced liquidation, so obviously you will give the highest weightage to asset approach. The respective strengths and weaknesses of the possible valuation approaches and methods. You may want to apply the income approach, but the data available is not reliable or it's not available at all. You may wish to apply market multiple comparable transaction, but the comparable transactions are not available. So assess the strengths and weaknesses of the possible valuation approaches and methods. The appropriateness of each method in view of the nature of the asset and the approaches or methods used by participants in the relevant market. Availability of reliable information, very important. If information is not reliable for a particular approach, it's better to give a lesser weightage to that approach or no weightage. And finally, price information from an active market must get the highest weightage because this is the best barometer. That's the word which has been used in the standard. 10.09 talks about when different approaches and or methods result in widely divergent indications of value. Then the role as a valuer is we need to understand why the value indications differ. I've already explained the pitfalls of averaging out. And this is exactly what it says, that it's not appropriate to simply weight two or more divergent indications of value. Right? Very important because averagings could create a huge kind of complete chaos. So need to understand why they are different, corroborate the findings, and then pick up the right approach. Or maybe the different there could be some tweaking required in the discount rate or in the cost of capital so that it aligns with the implied EBITDA multiples. And the last one, 10.12, I have highlighted it in red, the last part. Active market is generally considered to be the strongest evidence of value. So these are some of the indications which are available. Then some more indications, some more guidance which is available under IVS. So one is the generic. So these are the generic ones, and then approach specific clauses under IVS. So each of the approach they have given when and how, in which situation it should be given the significant weight. So let's first talk about the market approach. Market approach, it should be given significant weight under these circumstances. They have given these three situations. The subject asset has recently been sold in a transaction appropriate for consideration under the basis of value. So if the basis of value is the same and the subject asset has been recently traded, so you have a recent actual transaction behind it. Give a higher weightage to market approach. There could also be situations where the subject asset or substantially similar assets, they have actually been publicly traded. So that also becomes a good indication of value. Give a higher weightage to market approach. And there are comparable transactions, observable transactions in substantially similar assets. So these situations would warrant that a higher weightage to market approach is given. Once again, the standard never tells us higher means what, significant means what. Whether 10% is, whether 25% is significant or 50% is significant or 100% is significant. Again, we need to go back to the professional judgment. Your experience and your knowledge, wealth of knowledge which you acquired, that should kick in and that should come into play. Then comes the income approach. So under income approach, significant weight should be given under these circumstances. The income producing ability of the asset is the critical element affecting value. The companies which are into, uh, you know, low capital with low capital intensity, higher human inputs, IT companies, consulting organizations, where the income generating ability is a critical element. And or reasonable projections of the amount and timing of future income are also available. But there is a qualifier with this. Projections are available, but no relevant and reliable market comparables are available. So if you are in a situation like this, when reliable market comparables are not available, then also income approach should find prominence. Cost approach. These are the circumstances under which cost approach should be afforded significant weight. It is possible situation like where it is possible to recreate an asset with substantially the same utility as a subject asset. And the qualifier is without regulatory or legal restrictions. And the asset could be recreated quickly enough that a participant would not be willing to pay significant premium for the ability to use the subject asset immediately. So there should not be any regulatory and legal restriction, and there should be a possibility to create the similar asset and use it within a reasonable time frame. The asset is not directly income generating. So because income generating asset would get higher and prominent weight under income approach. And the unique nature of the asset makes using an income approach or market approach unfeasible. Sometimes the basis of value, it would clearly indicate that you should use the asset approach. If the basis of value is replacement cost, then obviously use the asset approach. And then there is also a situation where asset was recently created or issued and sold to market participants with a high degree of reliability in the assumptions used in the cost approach. So these are the 4 or 5 scenarios which have been envisaged by IVS, where the cost approach should be given a higher or significant weightage. How much it should be? Once again, it is left to the judgment of the valuer. We always face this challenge as to how to apply comparable transactions method. I gave you some indication in the opening discussion as to how to eliminate outliers, what all to capture, what should be the sample size. Here is some more guidance which is available from IVS, which says that the identify the unit of comparison that are used by participants in the relevant market. Now, unit of comparison could differ from industry to industry. If you are operating in telecom industry, so you may want to use value per subscriber. In logistics industry, the value per pallet, retail value per square feet. So these are some of the industry specific standards. So identify the industry and identify the comparative unit for that industry. Identify the relevant comparable transactions and calculate the key valuation metrics for those transactions. Consistent comparative analysis of qualitative and quantitative similarities and differences between the comparable assets and the subject assets. So it requires both qualitative and quantitative analysis. Then you need to make necessary adjustments for the differences between the subject company and comparable assets. Try to bring them closer. Apply the adjusted valuation metrics to subject asset. And if multiple valuation metrics were used, reconcile the indications of value. So you may have EBITDA multiple, you may have revenue multiple, you may have value per subscriber. So these are the multiple metrics which are available. Use these multiple metrics, identify the value and reconcile the indications of value. The next question which came to my mind was that what if comparable market information does not relate to subject assets substantially? When comparable information does not relate to the exact or substantially the same asset, we as valuer are expected to perform a comparative analysis of again qualitative and quantitative similarities and differences. It will often be necessary to make adjustments based on this comparative analysis. Adjustments must be reasonable and they must be documented. We discussed about the importance of documentation. Now comes what are the common adjustments to value to be applied on equity value. DLOM and DLOC, these are the most commonly used adjustments. And this is another very important area where valuers had to make a choice as to what the DLOC or DLOM percentage should be. The studies which are available, I mean, if you check the Google, There is a study called Finity study, Chef studies. I mean, these studies are very old studies and they do not relate to Indian market. Inkward has done some study on discount for lack of control, could be relevant to Indian market. There is some indication one can get as far as DLOM is concerned is from uh, Tata Motors. I think this was one of the pioneer company which came up with the shares with differential voting rights. So it created DVR, which had two differentiations. One differentiation was that dividend payout was 5% higher, and it also had the voting rights were 1/10 of the ordinary shares. Interestingly, in a situation like this, the price of differentiated voting right shares versus the ordinary shares of Tata Motors, there was a gap of 45%. Mind you, 45%. If we use this indicator as part of DLOG, it's a huge number. Need to be used with a caution. But that was the real life. This is one classic example in Indian context where we have seen the value of DLOG demonstrated in the value of shares in the listed domain. In fact, I have this copy of report when issued by PwC when these differential voting right shares, they got converted into the ordinary shares. So we'll quickly have a look at that valuation report also. That would give some insight as to how the principle of valuations have been applied and how much reliance has been placed on the market approach, because we have been talking about market approach, which is the best barometer. These are some of the methods by which you can quantify DLOM or DLOG. Option pricing model is studying and compare the value of publicly traded shares and restricted shares in the same company. Some of the shares are restricted shares and some shares are publicly traded. So these two can be compared. And simplest and easiest one is a study of the pre-IPO and post-IPO pricing of the shares. So that also gives the value attached to the marketability. And likewise, control premiums, you can analyze the specific cash flow enhancement or reductions in risk associated with control. What happens to the cash flows if the control changes? It may result in enhancement of cash flows, or it may also result in reductions. So assess and analyze that. Then comparing observed prices paid for controlling interest in publicly traded securities to the publicly traded price before such a transaction is announced. So many times these publicly traded companies, they are taken over by some unrelated party, and the transaction happens at a value which is very different than the share price. Because the price which is reflected in the market is a retail price. It is not a control price. So a study of this, that what was the price in the market and at what rate or value the deal has been struck to acquire the controlling interest, that also gives an indication. So I shared with you, I mean, I was browsing through the studies on DLOG and I found out an interesting study from Inkward. This is available.
Rajesh, sorry to interrupt actually. This DLOM, how you are saying I mean, option pricing model can be used? Can you just explain actually?
See, there are put option models which can be used as far as DLOM is concerned, because as for marketability, if there are options available for someone to buy or sell, the value of that option can be calculated, and that becomes the some study or benchmark or assessment as to what should be the DLOM value. Thank you so much for this question. And then in the context of D-Log, comparing trading prices of stocks with and without voting rights. So this we discuss in the context of Tata Motors. Ravi ji, can we take a break for 2 minutes, a bio break?
Yeah,
That
sure,
is,
sir.
yeah.
So, Chandrasekhar sir, did you ask the question on option-based model, sir, for DLOM? Ravichandran sir, did you ask?
Yes, I asked Ranjit. Yeah.
I mean, essentially, when we say marketability, that means
Okay,
I should be able to sell it at a particular price comfortably. Then there's complete marketability, right?
correct.
Now, suppose if I want to sell at 120, I am not able to do, and I could sell it comfortably if it is to be, it is sold at 100 rupees. Market price is 120, but
Okay,
I cannot sell it easily unless the price becomes 100. That means you're discounting 20 rupees for that. That is nothing but
okay,
your ability to write. Probably you're putting a premium of 20 rupees. So when you are
okay,
saying that you want to write to sell, what is the price at which you could sell? Use that as the basis, probably in your Black-Scholes model, to determine the premium. That premium becomes the discount.
okay.
Marketable, lack of marketability.
Lack of marketability. Okay,
So because end of the day, marketability means I should be able to sell it, right? If I'm unable to sell it and I can only sell it when I discount my price, the discount becomes the premium part of it in a option pricing model.
okay,
The challenge in all these things is essentially you won't get the data of volatility and all other parameters for you to apply. So you make a
right.
lot of assumptions there, but end of the day, marketability is all about assumptions. So make some of those assumptions based on the industry benchmark and try to determine the pricing.
Well, I have not seen any report. People just put some ad hoc number for DLAM.
That is subjectivity or
Ah,
arbitrariness, not even subjectivity.
arbitrary, correct. Yeah. Thanks. Thank you. Yeah.
No, thank you, Ganesh, Mr. Ganesh. Thank you for that insight on the option pricing model.
Sorry, you were not there, sir. So we just
No,
indulged
no,
in
not no,
what
no. It's okay. It's perfectly fine. And as I mentioned at the beginning of the session, we are here to share our collective wisdom with each other. So by all means, I would encourage other participants also to share their experiences on these specific points which we are discussing here. The next challenge is what should be the explicit focus period. Now, this is the easier one to deal with, I would say. Not that very difficult, because we should talk about the life of the asset, or we should talk about the period within which the cash flows have stabilized. I think it's fairly simple and easy one. And you should also try to cover and capture the cyclical movements of assets so that the entire cycle is captured in the explicit period of forecast. The recently introduced IVS, it has captured a specific para on this, that in some instances, particularly when the asset is operating at a stabilized level of growth and profits at the valuation date, it may not be necessary to consider an explicit period forecast period, and a terminal value may form the only basis of value, sometimes referred to as income capitalization method. I think we all are familiar with this, that no need of any forecast if the business is already stabilized, straightway applied terminal value formula or income capitalization method onto that. Okay, another interesting one. What happens if client advises valuation method? I have dealt with this, in the opening commentary. Here is what IVS tells us. So 10.13, it says a valuation may be limited or restricted where the valuer is not able to employ the valuation approaches, methods, and procedures that a reasonable and informed third party would perform. And it is reasonable to expect that the effect of the limitation or restriction on the estimate of value could be significant. So there are two things which are mentioned here. The word used is and. A, you are not able to employ certain approaches, methods, and procedures, and the expectation is that this could the impact of this could be significant. 10.05, it uses the definition of the word professional judgment. We already seen the definition. If in the valuer's judgment, professional judgment, the work is overly restrictive, this may not result in an IVS compliant valuation. Keep in mind. And 10.11 talks about the valuer should exercise professional judgment in determining the valuation approaches, methods, procedures. If there is a limitation to professional judgment placed on the valuer's selection of the valuation approaches, methods, and procedures, then which are overly restrictive, this may not result in an IVS compliant valuation. So this is what the standard tells us. But at the same time, what I have discussed in the opening discussion, that the value is already arrived at, investor is identified, investee is identified, and then we as valuers are required to validate. In situations like that, we should be able to comply with the standard. We should be able to apply the approach, value, methods, and procedures which we are expected to apply. That is what it tells us. Discount rate, one of the most discussed and debated. Now, as far as discount rate is concerned, let us look at the ingredients of discount rate. Risk-free rate, a reasonable indication can be found. You can pick up the link wherever you have taken the risk-free rate, paste it in your valuation report. Market return, again, a reasonable indication could be found. Beta, little tricky, but still beta parameters of the industry are available. The process is to filter out what applies in your case, what doesn't apply. The moment I try to convert this into a modified CAPM, where I need to assign values to the size risk premium or company specific risk premiums, it becomes tricky. Each company has its own nuances. Incidentally, Inkward on its website, it has a size risk premium study. You can refer to that. Company specific risk premium still remains to be a huge gray area and question mark, and requires a whole lot of professional judgment as to what it should be. So while applying the discount rate, there is also a corroborative approach which one needs to take. And probably this would give some idea as to what should be the company specific risk. If you look at the weighted average return on assets, VARA, apply that VARA onto that company. Or value indication from other approaches. We already talked about that approaches should not be too divergent with each other. You need to understand some fallacy or some mistake has happened, or the discount rate has not been taken correctly, which needs to be taken more reasonably and appropriately. So, or maybe you can also do it this way, that based on the discount rate which you adopted, find out the implied EV and EBITDA multiple, revenue multiple, relevant multiples you find out, and then corroborate the findings with the EBITDA multiples available in the comparable companies. So that would also give you some sense as to whether the discount rate has been chosen appropriately or not. And this is what the guidance from standard is A20.32. And this list of is non-exhaustive. This is not the complete list of assessing the appropriateness of a discount rate. Mandatory requirement as far as discount rate is concerned, you must document it. Provide evidence for the derivation of the discount rate, including the identification of significant inputs. Support, provide source. The other one is that valuer must consider the risk of achieving the forecast cash flows of the assets. Now here comes the subjectivity on the part of the management. So discount rate falls in the domain of the valuer. As far as forecast cash flow is concerned, our role is to assess the reasonability and appropriateness. Forecast has been prepared by the management. We need to assess the risk of achieving. Some of the classic examples, the way it can be looked at is market share. If there are 2 or 3 players in the industry, how likely is it that one player would get more than 50% market share? In the classic scenario, like, where there's a license industry, there are 3 players, the 4th player is not likely to get license. Is it possible to get one player gets 60% or more market share? It may be possible, but is it backed by some specific strategy, specific market spends, and have they been captured in the numbers? Prices. There are certain industries inherently we know that the price keeps falling. If you talk about IT industries, if you talk about hardware, IT hardware, mobile phones, we know that the prices keeps shrinking. They keep coming down. In industries like these, if the forecast cash flows, they talk about price points which are very different than the current price points. Again, a cause of concern. So some of these specific areas one can understand, look at. I have a separate slide on the qualitative and quantitative assessment. So we'll discuss more about this. Okay. Now, to deal with subjectivity, there is a specific need and requirement to do a deep dive into the business of and the industry in which the company is operating. More often than not, we spend more time in doing the number crunching and less time in understanding the business model, whereas it should be the vice versa. More time should be spent in understanding the nitty-gritties of the business. Unless and until you have a strong hold onto the business, you may not be able to translate that into the quantitative numbers. Identify value drivers of the asset. What drives value? If you take the case of FMCG companies, the value is driven by 2 things. A, their brand, and B, their distribution network. That drives the value. And you may also ask for past valuation report of the subject asset to understand what has gone through and what has happened in the past. So understanding of business and industry is extremely important. Spend more than 50% time, that's my view, in understanding that. Once you've understood that, it is easier to eliminate the subjectivity part in the valuation. If you have a stronger understanding, a deeper understanding, you will be able to apply the comparable transactions, guideline companies in a more, objective manner. You will be able to assess the appropriateness and reasonability of achieving projected financial information. These are some of the mechanisms of assessing risk of achieving forecast cash flow. Identify the key components of the forecast cash flow and compare the forecast cash flow components to. So these are some of the areas, some of the pointers for that. Historical operating and financial performance of the asset. So historical performance would also give a good guidance as to what the future is likely to be, unless something specific is being done in future. Some new capacity expansion has taken place, for which capex has to find part in the financial model. Some specific business strategy has gone into, some new patents have been acquired. So understand that and then corroborate it with the historical operating and financial performance. Then one can also look at the historical and expected performance of comparable assets. Historical and expected performance of the industry. There has to be a very strong reason when and how the industry performance can be breached by the company. It's not that it cannot be breached. There could always be certain companies in an industry who are performing much better than the industry. It could have happened historically, and it may also happen, if not happen historically, it may happen prospectively. And then assessing and understanding near-term and long-term growth rates of the country or region in which the asset primarily operates. So what kind of cash flows have we considered? Have we considered the best case scenario? Have we taken the worst case scenario? Have we taken the base case scenario? Or is it the probability weighted scenario? Ideal would be to assess different type of cash flows, best case, worst case, base case, and assign probabilities to that, and and work out probability weighted scenarios. The other important thing is, in terms of forecast, is what has been the past performance of the subject company. Companies do make budget, they make business plans, and then they achieve that. So if you look at the historical performance of the company, their historical budget and business plan versus their historical performance, what is the degree and percentage of assessment and achievement? If the achievement is 70%, 30%, 20%, that gives some kind of indication about the ability of this company to achieve the projected financial cash flows. It's a very good tool which gives the good indication about the probability of achieving and to what extent it can be achieved. Qualitative factors. There are a lot of qualitative factors which impact the cash flows. In fact, the starting point should be qualitative factors, and then comes the numbers. Because qualitative factors and strategy, that drives the numbers, not vice versa. Consider the value indications from the market approach, means corroboration of the information. Another very important point which has been added in the new IVS is the ESG. It has been made mandatory to comment and capture the ESG elements, environmental, social, and governance.
Sir, here I have a point.
Yeah.
Sir, in my report, valuation report,
Yeah.
okay, if I say that I have considered ESG and then arrived at alpha or cost of whatever, is it okay? Or I have to examine, I have in my statement in the report, I have to say in E, I have, E environment in a software is different from manufacturing. Same thing, sustainability and governance differs from industry to industry. So I have to capture the relevant factors and then explain in detail that with respect to ESG, I have examined all of this. And then, so how is it? Can you please share your experience?
Okay, all right. See, there are certain companies by law which are required to make disclosures for ESG. As valuers, we are not auditors. We had to rely on the information which is available on the table. And I would not expect a valuer to do a deep dive to understand these three elements of a company, except that he must take into account some degree of reasonability. Now, where this reasonability comes from, let me dissect this into multiple parts. There are top 1,000 listed companies by market capitalization, which are mandated by SEBI to publish a BRSR report, Business Responsibility and Sustainability Reporting. So those companies, they already have that report. You have availability and access to the entire information relating to ESG. Then there are companies which were anyways publishing their ESG performance by way of IR, integrated reporting, or GRI, global reporting initiatives, or any other, there are multiple such frameworks. There are almost, 3 to 400 frameworks under which these reportings are made. So if you pick up the balance sheet of any large company, besides BRSR, you will also find GRI, IR, or any such reporting, TCFD, climate-related task force. So you will find all of this. So that's another source of information. We come a level below that. Then there are companies who are required to comply with Section 135 CSR Act and rules. These companies in the board report also, they are mandated to give about the performance of CSR, how much money they were required to spend and how much has been spent. So that's the next level of indication. The next one is in the board reports, the companies, they disclose their corporate governance, how the governance has happened. That gives an indication. Then we come to the environment part. As far as environment is concerned, you may find some semblance of this in the notes to the accounts. Whether the company is compliant in the report part, in contingent liabilities part. Many times there are certain mandatory requirement to comply with the environment. If that is not complied, then the business runs a huge risk. So the assessment can be oriented towards some of the specific pointers. Either they're publicly available, or as a valuer, if you have very, very specific thing in your mind, you can ask those questions from the client that, look, I want to assess these few specific things because you're operating in a hazardous business. And if you don't follow these regulations, I need to have a clarity. Maybe you can get that clarity by way of a management representation as to have you actually complied with, and how are you managing a business so that you don't run the risk of shutting down of the business. So this is the framework which comes to my mind as far as information collection is concerned. Now, let me come to the second part of it. Once you have collected the information, then how do you deal with that information? In my mind, if you want to comply with ESG in the short term, it results in a higher cash outflow to the company. A non-ESG compliant company may generate in the short run larger cash flows. Examples. Because I am concerned about the welfare and working conditions of my employees, my social quotient is high. Therefore, I'm providing better working conditions. I'm taking care of their health. I'm taking care of their families. This is the social aspect. Now, this social aspect is resulting in higher cash outflow in the short term. But the belief is that if I do this, then I'm expected to generate more cash flows in the future. The empirical study tells us that a company which is ESG compliant, it generates higher valuation. I mean, it's proven. It's no brainer. So therefore, what I'm doing is I'm sacrificing my current cash flows to generate higher cash flows and or to generate higher valuations. Then there are companies in various markets, in European market, American market, who put so much of emphasis that on ESG that they would not buy products, goods and services from companies which are not ESG compliant. Now, if you are a non-ESG compliant company, then this also need be factored and captured in the cash flows. That who is your customer? Is your customer telling you that you have to be ESG compliant, otherwise I'll not buy it from you? You are most likely to lose that order. Many times customers, they give moratorium. They say, okay, run this for next 6 months, next 12 months and become compliant. Have the appropriate steps been taken by the management to comply with this within that period so that the customer doesn't go away? There are customer dependencies. If the business is critically dependent on a customer who is generating 20%, 30% of revenue, obviously you need to understand that specific nuance. So the sum and substance is a collection of information as far as ESG is concerned. Assimilating and applying that information in the model, it may result in additional cash outflow in the short run. And then disclosing it in the valuation report.
Sir, there is a question.
Yeah.
Sir, how to quantify this ESG factor
Hmm.
in the report? Suppose we know all the factor ki this governance part, social part. But how to quantify this in the report? Suppose we are using this discounted cash flow. We are using the how to quantify whether we have to predict the cash flow accordingly, as you say, a good ESG company initially have a low cash flow, but in the future. But exactly how to incorporate this ESG factor in our report?
Okay. Sandeep ji, this is a new provision. We have not seen much of working on this specific provision. Now, I can give you certain indications which I have personally applied. When I talk about environment, because I'm non-environment, I'm not compliant with environment. Therefore, I am required to make certain investment in certain assets. So value of those assets need to be captured in my capex. So that's one part. I gave you example of social part. If I had to be socially compliant with my workers, then of course I need to do that part also. So identify some of these areas. I gave you example of a customer. If I'm a non-ESG compliant and the specific high value customer, his requirement is that I have to be ESG compliant, which I'm not. I'm most likely to lose that customer. Eliminate that customer's revenue from the cash flow. So the trick is to understand where the company stands, what kind of industrial business is it in, and whether it is compliant or not through the publicly available sources. And I gave you some of the sources which are available. In spite of that, if you have any specific question from the subject company, ask it and take the answer on the MRL. And that can also become part of your valuation report. So it's up to you as a valuer to assess the risk of ESG for that company and quantify it in some of these manners which I just now stated. Whether additional capex or additional cash outflow on OPEX side, or losing out a customer or getting a new customer, it can also result in positively. So if you become ESG compliant, then you can also say that, look, today I'm doing a business of X crore every year. And because I'm ESG compliant, now the entire European market has opened up to me. So my revenue is not going to remain X, it has actually become X square. Because I have access to better markets, I have access to better customers, I can get better pricing. So these things need to be understood. You can build your own template of questions and queries, present it to the management, seek their answers, and then factor it into a valuation report.
Okay, sir.
Yeah. So I hope I have been able to address some part of the question.
Yes, sir.
Sir, one more, sir, this is Subbarao. One more thing.
Yes,
See,
Subbarao.
as you said, okay, we quantify the projections or income projections by taking into consideration of ESG. Then do we need to mention about ESG, some disclaimers, okay, whether the company is following ESG norms or not? Like 1 or 2 paragraphs we have to give in the report.
Absolutely, Subbarao-ji, absolutely. And if you see the valuation standard, IBS, it has made it very clear that valuer must consider ESG factor. So consideration means it has to find prominence and place in the valuation report, whether it is complied, not complied, what are your findings. You may put half a para, 1 para, and how have you dealt with those nuances? Definitely, yes.
Yeah, like how brief profile of the company we are giving in the report. Maybe at the time of requesting the information, we can ask the company, okay, like brief profile of the company, and we can add one point ESG compliance about the company. We can ask them. The
Absolutely.
same thing we can frame it, okay, reproduce in the report, like 1 or 2 paragraphs about ESG compliance.
Absolutely, Subbaravji. Must be done in my view. And there has
Yes,
to be a specific para. Don't embed it into anything else. Create a separate
yes,
para with a specific requirement under IBS.
yes, yes. Thank you, sir, for clarification.
And you know, as I mentioned to you, this is such an important factor. The whole world is moving towards ESG.
Correct.
And if you are lagging behind, then definitely you are losing out on few customers, you know, a few things here and there. So it may look good to save some money, penny wise, pound foolish type of situation, but doesn't help. And empirical studies are so many on this, that there are ESG compliant companies. It is empirically proven that they are generated much larger value compared to the others.
Now, even right now, I'm doing one solar company valuation where
Okay.
we can mention, okay, this ESG compliance, how they are doing and how it will be like useful for other companies or for the society also.
Yes. So how they are doing part, I understand and agree. But how is it useful for other companies? That has to
No, other
get
companies, no, the social at large, like, okay, like
yes,
even
absolutely.
this.
Yeah, correct. Agree.
Thank you. Thank you, sir.
Okay, all right. So this brings us to the next point. Now we talked about the forecast cash flow. What do we do? The forecast. Can you as a valuer adjust the forecast? The answer is twin. So if you do not agree or do you believe as a valuer that there is a serious risk in achievement of the forecast cash flows, you have two ways of tackling the situation. Situation one, adjust the forecast. Provide the rationale why these adjustments were necessary. Undertake quantitative procedures to support the adjustment and document the nature and amount of the adjustment. So the context which you discussed just now, ESG, just apply that context and adjust the cash flow if that be the requirement. The second possibility could be you adjust the discount rate because there is a higher risk of achieving the forecast cash flow. So the discount rate should be higher. But in this case, what the standard tells us is the valuer should document it as to why it was not appropriate or possible to adjust the cash flows and provide the rationale that why this risk is not captured in the discount rate already. Because what you are doing is you are adding the discount rate because of risk in achieving the forecast cash flow. So the first situation is you either try to adjust the forecast. If you're not, then you document the reason why it is not possible. And then you need to document the second thing, that why such risks are not already covered in the discount rate. And then you arrive at the discount rate, maybe add some filter or add some percentage point, basis point to it. Highly subjective. I don't have any specific answer. If anyone has dealt with a situation like this and any specific scientific method deployed, we'll be happy to discuss and deliberate on that.
Sir, recently I did one case actually where I did this adjusting the discount rate only.
Sure.
Because the specific risk premium, company risk premium, I just enhanced actually. Because the forecast, if I adjust that person, it will lead to a lot of arguments. Practical side, actually, he will say, yes, I will achieve that. So each and every item, I will have to change it. So instead, what I did is that just increase the SCRP and then did the actually.
Okay, but finally, what was the number? And how did you arrive at the number?
Hey, it was an arbitrary. I mean,
Arbitrary.
I'm not saying that is
Yeah, sure. So
but,
the question, Raviji, is that I understand number would be a subjective number, but what did you mention in the report? That is more important.
I
Maybe
mentioned that the forecast is, as you rightly said, is not achievable actually. I mean, there is a risk of achievement. I mean,
Okay.
overshot actually. Therefore, we are increasing the specific risk premium.
Fair enough. Fair enough. Yeah. So, I mean, again, the point is
It's a very
that,
aggressive forecast. That's what we said.
sure. So, I mean, again, the point I'm trying to drive home is the fourth approach, objectively subjective. So you have been objectively subjective. Terminal value. I think I gave some views from my side on terminal value, and I'm happy to discuss this part also. If anyone has any experience and better views how to arrive at the terminal growth, I gave you the theoretical framework. So I'm open to discussion on that and build a collective wisdom on terminal growth rate. Ganeshji, would you like to share something here?
Sir, normally this GDP growth rate is we actually taken.
So GDP is, let's say, 6.5%. So you would take 6.
Below that, sir, below that,
Below
below
that.
that, not more than normally 3 to 5%, sir.
3
But
to
not
5%.
there is any specific criteria. Normally we mention the assumption ki growth rate is this. But as such, we don't mention in the report that we have how we have concluded for this value. In the itself, we don't mention that it is below than GDP, so we have taken normally just a assumption. Is
Right.
there anything we should have to mention? Kindly explain.
No, I think that is the way it is being dealt with by valuers. So it is more a judgment and being cautious and aware that it should not breach the GDP. So it's a hidden message, you would never do that. And slightly higher than inflation. See, the question which I have in my mind, and I'm open for discussion on that, when I'm building a 7-year explicit forecast period, so at what stage am I applying this TGR? At the end of the 7th year? Now, should I look at GDP at the end of the 7th year, or should I pick up today's GDP and start applying over there? That's the question I have in my mind.
Sir, I think we should have to take today's GDP because right now for the 7-year projection and because the revenue is coming from the first year, second year, third year, fourth year, and if we assume for the 7-year growth rate, because we have to base on this, I think we should have to take the right now.
Okay. Okay. And any other views on TGR from anyone? Thank you so much, Sandeepji.
Yes.
I feel it is difficult to forecast the GDP growth rate after 7 years.
Yeah.
Say we may forecast something, but it may go away. Say
Correct.
there may be a quake or natural calamity or some other reason. I think better to take the present growth rate.
Patriotic present growth rate. Right. So you agree that we should be falling somewhere between inflation rate and GDP in our TGR?
In here, I got one contradictory view regarding the GDP, taking the GDP growth rate. Say in India, say it is around 7%, 6 or 7%.
Yeah.
Okay, correct. In India's case, but whereas when I message for the growth rate for USA and Japan, the USA's growth rate is GDP growth rate is 2.8% and Japan is 0.8%. But in their cases, I think it may not hold good.
Right. No, that's the jurisdiction which you're talking about.
Yes.
Any other views before we move forward to the next slide on TGR? I think this is a very, very important element. And I mean, this is a game changer. You take 1% TGR versus you take 5% TGR, the outcome would be completely different.
I think most of us take 5% by default.
5% by default. Okay.
GDP is around 6.5, like that. It is hovering.
Yeah.
We take safely 5% and
I think Raviji, I would tend to agree with that. You know, that's a much safer. And in some of the cases, where the industry is stagnant, you may want to come down to, let's say, 3% or maybe some such number. But going beyond 5 is, I have not seen the reports. I mean, from even other valuers, that anybody has gone beyond 5%. In Indian context, I'm talking about.
Sir, I have a point to this.
Yes, yes, Shilpa.
There are some high growth companies, say for example, something like EV or something, wherein, like if you see the automobile, conventional thing, how growth it was, and now everything will shift to EV over a period of time. Can I consider more than 5%? Certain industries which are more
Okay.
futuristic.
So, Shilpa, my response to that is what is the fundamental? Fundamental is the business has to stabilize. So I would say that you elongate your explicit period of forecast until the business is stabilized. Take a longer term explicit period till the business has stabilized, and then apply the TGR of a reasonable number, 4-5%. That's the way I would look at.
Thank you so much. All along I used to apply 5%, but I had this doubt. Thank you so
So
much.
just elongate your period of explicit forecast, because your business is still not stabilized. You are in EV industry, it's high growth, growing. So let it grow for next 5, 10, 20, 15 years. And then when you feel that now it is stabilized, because this is what the standard also tells us.
I too of the same opinion, but at the same time, when we are considering the terminal growth rate, it is for the long term. So in the long term, it cannot go beyond the GDP growth rate.
Exactly. Absolutely.
Initially,
Fully
we started
agree.
maybe for about 10 years or so, but not beyond that. By the time or any other particular industry, we stabilize and the growth rate may be around the same rate of GDP.
Correct. So it is highly unlikely, or rather I would say impossible, that any company in the long run, in perpetuity, beats the GDP of the country. Any industry or any business. Not possible.
Take the case of mobile phones. Initially, the growth rate is so huge.
Yeah.
But later, after everybody has got the mobile phone, then the growth rate for mobile phones is less.
Correct. Somewhere it has to taper down, somewhere it has to become more reasonable. Okay. So I think let's move forward from terminal growth rate. Now, the next question which came to my mind was what to communicate through the valuation report. I have already discussed this and we have been interactive on this specific part, but let's see the language of the standard. It says in 106, in all instances, the report must be sufficient. The word used is must, to describe the conclusion reached and be considered reasonable by the valuer applying professional judgment. And 30.08, it says valuer concludes, if the valuer concludes that the limitation or restriction will impact compliance with IVS, the valuer must not state that the report is compliant with IVS. So 30.08 is reasonably simple and clear that it is not IVS compliant, but let's delve upon or deal with 30.07. This is where, to my mind, is the trick lies when you talk about subjective valuation or objectively subjective, which I refer to as the fourth approach. How do you communicate? How have you applied your professional judgment? Some of these things, they are softer part of our life, soft skills. Nobody tells us, how to communicate in the valuation report. We need to apply our own mechanism and methodology to communicate. And rightly so, because the person who is reading your report, he is not sitting in front of you. He only has a piece of paper. He will decipher, understand, or misunderstand based on that document. So we need to give him enough clarity by way of what is going into my thought process in my mind while drafting this report, while arriving at this valuation through the valuation report. Then I started looking at how Supreme Court has looked at subjective versus objective. And my assessment is that in most of the cases, Supreme Court has upheld the professional judgment of valuers, and that's my view. I mean, I'm open to discussion on this if there are any differing judgments or any contrary views taken by different courts. Then I also try to look at what is the definition, because there is no definition available in the standard of subjective and objective. So here is a definition for whatever it is worth from Oxford Advanced Learners Dictionary. It says that subjective is something that is influenced by personal feelings, tastes, opinions, and is therefore not universally verifiable. Subjective judgments or experiences may vary depending on the individual's emotions or perspectives. The objective word has been defined in a way that it refers to something that is not influenced by personal feelings or opinions, is not influenced. So it's reverse of subjective, and objective information is independent of personal biases and can be verified through external observations or measurements. So I just thought, let me share these definitions, but the crux we have already discussed. Now, the most, I thought that no discussion on valuation is complete unless and until we talk and discuss about Professor Damodaran. So here is a leaf from his book. I found this slide to be interesting, so I thought of pasting it straight away from his book. There was a presentation I was going through from him. Value is equal to story plus numbers. We have discussed this in last 1.5 hours. And very clearly, you first have to have a story, and then only you can translate that story into numbers. You have to have a strategy and then translate into the numbers. So if you talk about the favored tools, your accounting statements, your Excel spreadsheet, your statistical measures, pricing data, these are all numbers. And the numbers people, they will handle it. Illusion, delusion, data is precise, it may not be precise. Objectivity, data has no bias. Control, data can control reality. Favored tools for story, you may have anecdotes, you may have own experience, you may have behavioral evidence driven by the narrative people who are not driven by numbers. And illusion, delusions, creativity cannot be quantified. How do you quantify creativity? There are many startups who start out of 100. Few of them, they become unicorns. 70-80% they disappear. Remaining maybe 15-20%, they remain somewhere in the middle. So you can't quantify the creativity. If the story is good, the investment will be. If I have a strong story, my valuation is going to be higher and my investment is going to deliver me a better ROI. And experience is the best teacher. Who are the people behind it? So they just thought of sharing one slide from Professor Damodaran. These are the commonly available sources. So I think we are all familiar with this, of information which we use in our valuation reports. So I'm coming towards the end of my presentation, and I thought, let me just deal with IBC scenario also, because when we talk about subjectivity, IBC is a very important piece of legislation, and some of you may be doing IBC evaluations, and I know for sure that there are valuers who consciously do not do any IBC evaluation. Within my own fraternity, I know there are many who just don't consider this to be getting into. For a variety of reasons, we are not getting into that. So Regulation 35 or CIRP says that 2 registered valuers are to be appointed. Now the first line itself has captured and taken into consideration that yes, valuation is subjective. You can never have a single number. So they decided on that basis only. That's my belief. And then they went further, a step beyond. They said if these 2 estimates differ significantly, then you appoint a third valuer. And they also defined the word significantly if the difference is more than 25%. So IBC, they took into their stride that yes, valuation is subjective. The values could be different and they may differ. And they gave a prescription for that. There's one more important thing which I noticed in Regulation 35, which I've highlighted in red color. I'll read that out for you. It says, provided that the resolution professional shall facilitate a meeting wherein registered valuer shall explain the methodology being adopted to arrive at valuation to the members of the committee before computation of estimates. This has gone I would say, way beyond what is stated in standards and what we have been doing in our life. So the meaning of this, the way I understood was that before, as a valuer, I start doing the evaluation, I should explain my methodology to arrive at valuation to the COC. How am I going to approach? What is going to be my methodology? If anyone has, been subject to presentation before COC, I'll be too happy to hear the experience and how it went. I'll just give a pause here for this specific clause. If anybody wants to share his experience on IBC or on this clause.
Sir, you will not get any comments from COC, sir.
Yeah, well, we may not get comment from COC, but if anyone has made any presentation to COC in compliance with regulation 35B proviso.
No, it is being done now because as a mandatory, this thing is being done.
Yeah.
But they just read out what is there in the report.
Okay. So
That's
nothing
all.
beyond that.
Nothing more than that.
All right. All right. Okay.
My case is a little different. So, as an AR in one of the home infrastructure projects, and I attended one COC meeting wherein the valuers had presented their presentations as to how they have arrived at the valuation and their methodology.
Okay.
And wherein the COC members had posed some questions as to how they have arrived at.
Okay.
And there were some different views from the by the COC members as present, again as the views of the valuers.
Okay, great. I think it's good to understand it here. Thank you. All right. So in today's era, no discussion is complete unless we look at ChatGPT. And out of curiosity, I gave this command of subjectivity to ChatGPT. And let me share what I found. This is what ChatGPT gave me. And my question was how the subjectivity in valuation can be minimized. So I'll skip all of this and I'll focus on just this part, which I really liked. I've highlighted some part and we can quickly spend a minute or so onto this part. See, it talked about common biases in our mind, confirmation bias. Avoid looking only for data that support your existing belief. So I believe this company's valuation is this a great company and this valuation should be $1 billion. So that's a confirmation bias. I start looking for things which confirm my belief, right? So that's one kind of bias which I can build into my behavior. Anchoring bias, don't overly rely on an initial figure or assumption. In my mind, I already have a number. So that's my anchoring bias. Yeah, this company's valuation has to be $5 billion. So that's my anchoring bias. So I start from that point and I try to justify that in my mind. And then overconfidence bias. Be cautious of subjective certainty that it is not backed by data. Again, it relates back to somewhere around anchoring bias or confirmation bias, overconfidence. And then the fourth is the most important, recency bias. What happens is, whatever we see and hear in the recent past, that remains ingrained in my mind, and we keep forgetting, the human mind keeps forgetting the past incidents or events, though they could be more important and more relevant, and maybe more in numbers. So the event which has happened immediately, which newspapers are reporting, which social media is talking about, that immediately gets ingrained in our mind. So we build a recency bias in our mind. So these are the four kind of biases which I found to be interesting enough to talk on this platform. And just thought as out of curiosity as to let me see what ChatGPT has to say about subjectivity. And finally, I come to the end of my presentation with the thought that we should all be objectively subjective. Thank you so much. And we still have a few minutes left. We can discuss if there is anything else which we want to share as a collective wisdom. And I'm very...
Sir, I have one question about
yes,
ESG.
Yeah.
If it is possible, okay, in the interest
Can I stop sharing this? Let me just shut this down. Yeah. Okay.
For the interest of the members, okay, like why
Yes.
don't you throw some, okay, like message means like the what we can include that ESG about ESG in the valuation report, general thing. Because with your experience, since you are mentioning already in the valuation report, maybe you can show 1 or 2 paragraphs for the benefit of members.
So would you want me to talk now, or we want me to structure some paragraphs and post it on the WhatsApp group?
Yeah, you can talk for 2 minutes, then you can
Okay.
structure and
Fair
post.
enough.
That is very
Fair enough. Fair enough. So let's start. When we talk about ESG, let's first start with the information capturing that must find place in your valuation report. In my view, I'm giving my views here.
Yeah.
And what are those sources? I talked about BRSR, CSR report, board report, and maybe MRL given by the company. Okay, so let's first talk about that. That must find place. Second, based on that, what you have seen or reviewed, you give your critical analysis as to what you believe or belief is. Many times companies, they have some accreditation on part of ESG, some accolades, some awards given. So that gives a solid foundation that, look, I relied and this company is ESG compliant. And then the third part which you should talk about is, because you have seen all of this, have you made any tweaks to any financials or projections, or have you requested management to do anything on that? So these are the 3 specific things which should find place in the valuation report as far as we valuers are concerned.
okay. Now that means, okay, in a like in the 2-3 paragraphs, okay, if you phrase it, okay, at least people will follow all members will follow the standards. Then, okay, we can improve that report standards and all.
Correct. Correct.
Thank you, Mittal ji.
My pleasure.
Yeah. Any other questions?
Any other? Yeah. All right. So if there are no questions, we are hitting the timeline as well. It's 9:29. Time allocated to me was till 9:30. So I handed back to the organizing team.
You have handled a very short time, sir. Yeah. Vijaya?
Yes, sir. Yeah. Yeah, I request
Can
my
you-
ma'am to give vote of thanks for today's speaker.
Sir, I have one question. Sorry to interrupt.
Yes, Induji, please go ahead.
Sir, as we know that SEBI has asked merchant bankers not to give the valuation reports now because registered valuers should be given. But first of all, first question is, do we expect that that would be applicable very soon? And second question is, even if SEBI gives notice to them not to do any further valuation report, but Income Tax Act still allows them to give the valuation report for issue of shares. So do we expect that even income tax rules will change after SEBI's thing gets approved?
Anybody's guess, Induji. And I became a registered valuer in 2018. And even prior to that, whenever we discuss about this legislation, I couldn't figure out any rhyme or reason why a registered valuer should not be doing valuations under Income Tax Act. I mean, what is the reason? What is the inhibition? Nobody is able to give any logic to it, to be very honest with you. We have raised this topic in front of chairman of IBBI, in front of old-time directors, in personal one-to-one conversations, in panel discussions. There is no answer. So I leave this topic here because if something has no answer, it has no answer.
Yes, sir.
And it's illogical.
Sir,
It's illogical. I'll be very candid. I'll be very candid in airing my views. It's illogical. If you have recognized registered valuer as a specific profession, then it must find place in under Income Tax Act.
So
Right.
to answer this one,
Thank you.
the
Yes.
valuers bill has to be come into force. Then only this can be answered. Because even when before last year, when Nirmala Sitharaman ji came to Bangalore, we requested about valuation bill. Then she has said only one, okay, let IBC and other, okay, on the industry, there are so many enactments are there, let it settle, then we will take care of the valuation bill.
Yeah, Subaraji, that's fine. That's a good statement to have. But the country already has some sort of legislation under which we all are operating.
Yes.
So why not? And then on top of that, see what Income Tax Act is doing. They talk about some valuation, valuer mechanism, panelment under Wealth Tax Act. That act doesn't even exist, and you still keep talking about that act. I don't understand this. So I'm sorry to raise my voice in this manner, but certain things need to change immediately.
Thank you very much, sir.
No, thanks for this question.
Thank you very much, sir. It was a very, very insightful session. I would like to propose my heartfelt thank you from BVA. I know it's tough. We have a set of valuation enthusiasts who are always up on a Saturday morning just to log in and hear the speaker. And we are very much thankful to you for having shared your insights. Often when we do our professional engagements, we get carried away by the whole narrative. And when the narrative is in such a manner, and as you said, that recency bias, there is always a bias that actually goes in. But when we actually put our entire narrative, convert it into numbers and actually put it in a report, that's where we actually go back to the basis. And thanks for so much emphasizing on why need to have the basis. And with the whole landscape of peer review, I know this is something which is very important. And when we put the number there, we kind of question ourselves, am I right in actually putting that? It was so insightful for us, and I thankful to the BVA for enabling this, and thank you for all the members who have turned up today morning for this session. Thank you so much, sir. And on behalf of BVA, we would like to extend our small memento. Thank you so much, sir. Thank you so much.
My pleasure. Thank you very much, and have a
Thank
good
you,
day.
thank you very much, Rajesh ji. Okay, as on behalf of Bangalore Valor Association, we thank you very much. And also, if you provide 1 or 2 pages of that ESG and how we can mention in the report 1 or 2 paragraphs, and it will be very grateful.
I'll do that. I'll post some of this. Yeah.
Thank you very much.
Thank you, Rajesh sir. Thank you all participants.
Thanks a lot, sir. Thank you.
Okay.
Thank you,
all right.
Rajesh sir. It was a
Thank you.
very slow-paced presentation, very calmly, and people who have listened to you have really, there has been a lot of takeaways. So grateful to you for your time and in-depth knowledge. Thank you.
My pleasure. My pleasure.
Thanks a lot.
The best part was all the points were related to IVS, and most of us would have not even imagined that these points are easily coming in like this. So it is a great effort, and all the pointers very neatly collaborated and corroboratively linked with each of the IVS paragraphs, which is very beautiful and interesting.
We will be very grateful to you if the presentation can be shared, sir, because I'm sure it is a reference material for all the valuers who are present here.
Yeah.
Absolutely.
I
No
think,
problem.
Vijaya, you can collect the presentation and share it in the group, Vijaya.
Sure. I'll do that. I'll forward it to
Yeah.
Vijaya, and you can further circulate.
Thank you very much, sir.
Thank
Okay.
you all.
All right. Thank you. Thank you.
Have a great day, sir. Thank you.
Thank you.